Welcome to the daily update, where I'll go over the action in the market for Wednesday, October 8th, and we'll see how things look for Thursday, October 9th. Okay, well, it looked like we were turning a little bit more negative earlier on in the week, and then that was on Tuesday, and then Wednesday, now we seem to be kind of bouncing back, and we set new all-time highs again. And that's a sign of a healthy market when we're seeing a lot of this rotation and churning going on and it's taking place above the 20 period moving averages. And when I say moving averages, I mean both the simple and exponential version. That's why I use the plural for that. And so we didn't set an all-time high with the Dow. It was pretty much unchanged on the day, but we did with the S&P, the NASDAQ 100. Mid caps, small caps had a pretty good day too. We're seeing some improvement with growth of value. And our smart money indicators are trying to shift over to a little bit more positive, although we need more follow through. That's been the issue. We're not seeing big percentage moves with the indexes right now. We were down on Tuesday, we were up on Wednesday, but well under 1%. And when you base things around momentum, you need follow through to the upside or to the downside to actually, on a short-term basis anyway, to take advantage of some of these moves, more like swing moves. And that's been really challenging in 2025. We were swinging all over the place last spring. Well, since we came up out of that, there have been periods of time when the market shows some good conviction, but most of the time this year, it's really lacked solid conviction. Okay, so right at the open, we had a higher open. Futures were positive. We were above the daily pivot at 67.23. We climbed above R1 at 67.46. And then we hit resistance at Tuesday's high. That's kind of interesting. We could not seem to get above that. Then, as the day went on, we bounced between R1 to the downside and Tuesday's high to the upside. And then we closed near the intraday high, real near the high that was set on Tuesday as well, up 0.58% on below average volume. Okay, now we had a down day on below average volume, then we have an up day on below average volume. The government shutdown is still going on, and at some point the market's going to say, hey, we need some data here. But there's another side to that saying, do we really need this stuff? Do we need the Fed? Do we need all these government reports that are likely being very manipulated anyway? There are other reports that are released. Why not just focus more on those types of reports? That's not really what the market's doing, but there's that in the background, just saying, well, what do we need that stuff for? Let's get our information other ways and just use that instead. And there's no side to take on this. This is just some back and forth that's going on. Okay, as far as the technicals, we are positive on all three time frames. Of course, we're setting another new all-time high. Interest rates were unchanged with the 10-year yield. Market's not really too concerned about inflation right now. Still underneath the surface, this positive backdrop is that we're seeing fairly good economic growth without a lot of inflation. It's not down as much as the Fed would like, but it's not going back up with any real conviction either. And then geopolitically, I understand some kind of an initial peace agreement was reached between Israel and Hamas. We'll have to see how that goes. And of course, if this is something that you pay attention to, please look at different sources. We just can't trust the financial media anymore for anything truthful. And that doesn't, whether you're Republican, Democrat, right, left, you can't trust it. And you need to go in and find as close to what I call primary sources as possible. Those are people that are actually in the game, that actually really know what's going on, that can really explain things. And you can't get an answer about what's going on geopolitically, not just in this situation, but Russia, Ukraine, even in the U.S., other things that happen. You cannot get your knowledge from a meme, okay? Some of those memes are planted anyway, and they're not even giving you truthful information, or it's a little bit true or almost true, but a little bit not true at the same time. Again, that's not how I approach things for the stock market. I keep an eye on these things and I have a personal interest myself, but I don't bring that into the stock market because the stock market's not really paying attention to that currently. But if you, on a personal level, take an interest in this, please be careful of the resources that you use where you get your information and don't trust anything. And the way I do it is I look at a source, I see something, it's like, okay, that could be true. Well, then I try to verify it with other sources. And if they're kind of all telling me the same thing, then I'm more inclined to think that that's actually true. Where if it's just one crazy statement out of left field that appeals to emotions rather than logic, and I try to do that in the program too, remove emotion, hedge yourself so that you're not gambling. You can make decisions based on logic, what we really see. And to me, the proof in the stock market is looking at the charts. Okay, anyway, because even though we have this great thing called the internet with more information available to us than ever before, there's so much misinformation and disinformation out there. No matter what your stance is or what your beliefs are, for that matter, we have to do our own research and come to our own conclusions. And I've always been like that. And that's why in my program, I really stress critical thinking. I come up with a plan each day and on my website, which you're welcome to check out. But I say, now you might not agree with that. You may come to a different conclusion. This is what I'm coming up with based on what's happening in the market right now. You may take that and then vary that a little bit to your own stance. And I do the same thing. I'm an educator, and an educator does not indoctrinate. What they do is they try to promote critical thinking. They say, okay, here's one way of looking at it, here's another way of looking at it. Now, let's talk about it, and then you can reach your own conclusion as to where you think are what you think is right, what you think is wrong, realizing that as more information becomes available, that can change. And we've lost that in American culture, and I'm fighting like crazy to try to get that back. All right, I don't know why I went off on that, but there you go. Okay, so some comments. We set all-time highs with the S&P, NASDAQ, and NASDAQ 100. And then Tuesday, mega caps and tech and semis, they didn't have a good day. Well, they had a good day on Wednesday. So we had tech and semis outperforming. A lot of this is being driven by AI and comments that are coming out, reports and statements and things like that. Then we did get the FOMC meeting minutes, but it had little impact. And it showed that most officials believe that it's likely to be appropriate to ease policy further before year end. Okay, the market likes that. Here's another one. And also highlighted the markets viewed recent data in FOMC communications as signaling little change in the baseline outlook. The idea that they want employment to hold up fairly well, they don't want inflation to get out of control, but we still want to have economic growth at the same time. Though downside risks to the labor market were seen as having increased. That's what the market is saying. We didn't get the employment report last week, but we did get some other employment data, and we're not going to get, unless there's some kind of a shutdown deal that comes through, but we're not going to get initial and continuing claims on Thursday. But we saw some weaker numbers there, not falling off a cliff numbers, but weaker numbers. The market liked that. That seems to reinforce this idea that the Fed is going to cut rates in October and very likely in December and then out into 2026. And then gold still continues to go further above 4,000. Now we're building up a little bit more short-term momentum on the positive side right now. The Williams percent it fell off after Tuesday. It's now back on the list. And the CCI charts never came off the list, but they're showing a little bit more strength now. The stochastics, which since there are three different time frames of the short-term time frame, that's pretty much always on the list. And now in the short term with the RSI, we're breaking above that 70 level, meaning we're getting overextended to the upside there. The Arun is still giving a very high reading, and now we're back to being far away from the the 50 period moving average as measured by the boom indicator. No change to the scenario. I just kind of went through this. They're probably going to cut rates in October. That's what the market is anticipating, with also a heavy percentage or probability that they're also going to cut them in December. The dollar was up. It's actually turning over into a short-term trend. We want to keep an eye on that. If the dollar does start to bounce up, it's really the dollar weakness that has helped stocks in 2025. If other than just some kind of an oversold bounce occurs and we actually start to shift to a longer term uptrend with the dollar, that could put some pressure on stocks. We were unchanged with the 10-year yield at 4.13%. We're still neutral. Sentiment didn't even change. And that's another thing, too, is that here we are setting all-time highs, but we're not seeing a real euphoric environment as far as sentiment is concerned. We're seeing a lot of money going into the market, but people aren't taking off their hedges. They're not doing the things that they usually do when it becomes, let's really get in the market now because we're afraid of missing out. So this still could suggest that there's more room to move to the upside because we're still neutral with sentiment. We're positive with the trend. We're above the moving average. The green line's above the red line. Seeing a little bit of weakness in that chart that I'll go through. And with the up day, the bias is positive. Momentum, I've changed from mixed over to mixed to positive because now we're leaning a little bit more in on the positive side of things in the short term, and we still have this long term positive outlook that still is remaining in force. All right, so we just had the weekly NBA mortgage applications index down 4.7%. Last week it was a pretty big drop, it was down 12.7%. The refinance index was down 7.7%, down 1.2% with the purchase index. Here is that chart, and that was really the only economic report we had, and we get this every week anyway. So still negative, but less negative than what we saw last week. Then we have some Isabel Net blog charts here. Cumulative bull versus bear market points. This just goes back through history all the way to the early 1900s and tries to point out different peaks and valleys along the way. So you might find this interesting to just look at this to gain some insight. Then the bull market is almost 3 years old now. Of course, do you measure it from last spring? Do you measure it from October 23 when we hit a pretty big low there? Or do you measure it from October 2022 when we hit a pretty significant low there? And so this is just showing the red where we've been performing up to this point. Is there more room still to run to the upside? Okay, we'll have to see how things go in that regard. And then the probability of a U.S. recession in the next year, the consensus, or Goldman Sachs is at 30% here, but we have kind of 33% here to the upside and 19% to the downside, not really showing much in the way of implied probability here. So it's relatively low, but there's still, 30%. There's still a chance, but there's a 70% chance that we're not going to. And looking at other charts in the market, they're still anticipating that we will not go into a recession. Then this is kind of like they took five people and hooked them up to an EKG. The takeaway here is earnings growth has been concentrated in the mega cap growth and tech in recent. I have to move this over in recent quarters with the sector contributing to nearly 90% of aggregate earnings growth as we see this continuing on. So that's where the real strength is coming from. Other charts, other things that we've seen pretty much confirm that as well. Healthcare, been getting hammered, still underperforming the S&P, but we are seeing some money coming back in there. You have folks that maybe they're doing some bottom fishing now. Now, if this continues to go in, that could be positive, of course, for the sector. We're going to be watching the performance. I watch it every day because that's a defensive sector. And if we are getting ready to have some economic issues, we'll probably see healthcare start to perform much better than it has been. And here we go with our daily, we're overvalued. Yes, we are. Where we have the S&P at 23 with a PE ratio. Above 20 is considered expensive. Then we have tech, which is now getting up to 31, discretionary at 29, industrials at 24. Then even still expensive, but a little bit less than the S&P with communication and staples and materials is right at 20, where we have energy down here at the bottom as well. Okay, large cap equity positioning. This is still where most of the money is going, and we're not necessarily up to this one standard deviation level here. So there still could be more room to the upside that way. Then switching over to a different source, excuse me, fiat debasement. Another way to visualize it. Okay, for some of you, you might not be aware, we used to be on the gold standard, but all that changed in the early 70s under President Nixon, where it's like, we're just going to back our currency by the faith and credit of the US government. And when you have currencies that aren't not backed by anything, and now that's the euro, that's the yen, it's the US dollar, that's called a fiat currency. It's just paper, but it's still considered to have value. And so it says it's not dollar debasement, it's fiat debasement, and it's accelerated. So we're seeing this going down as we're seeing gold going up because gold is a physical asset. It's tangible. You can actually own it, and it's worth over $4,000 an ounce now. It was worth a lot of money 100 years ago, 1,000 years ago, 2,000 years ago, and it will still have some value to it in the future. And that's why it's a little bit concerning when we look at gold going up. It's like, why? What's going on? Usually when it goes up, that means there's insanity or instability or craziness that's going to start coming in. Well, the stock market's not seeing that, but the gold market is. Okay, commercial hedgers and the dollar. They're starting to go long here, so we want to keep this in mind. The smart money is taking its largest net long position in over 4 years. This is in the dollar. Now I look at a slightly different index here. There's a couple of different indexes that you can follow. It's not a trade signal on its own, but it's a powerful way to gauge market sentiment and positioning. So, okay, we see some money coming in. The dollar has been very weak. Is this some kind of a basing process that could go up? And that might pose some problems for stocks if we continue to go up. You can see that we crossed above the green area here. And if this continues to grow, the dollar may end up going back up. Then stacks. Schwab clients were net buyers of stocks for the fourth straight month in September. Everybody loves Nvidia. You buy your fractional share there, whip out your smartphone and say, I'm a genius at this, while also gravitating towards some smaller names, but they really like AI related stocks. That's where the craze is now. But and so far to this point, it's different than the dot com. It's different than the biotech. It's different even earlier on than the cryptocurrencies because there are actual earnings and investments behind these companies that make them a little bit more attractive. So to try to just compare them to dot com companies back in the late 90s, which were just dreams that had no earnings behind them. So there's something a little bit more substantial here. And it's continuing to shape their trading. Clients also ventured into sectors like materials, staples, and industrials. Now, staples are more defensive, but hey, you got to have toilet paper and toothpaste, whether it's good times, bad times. You know, I've seen my share. Okay, then retail demand rolling. This is estimated retail just getting very high here. We have just witnessed the largest retail investor buying ever. All right. And now remember, retail is not necessarily considered the smart money. It's what we typically refer to as the dumb money. And this is also you and I as individual investors. But we see people really jumping in here. They bought over 100 billion of US stocks last month, the largest 1 month buying on record. Okay. All right. So people love the stock market right now. I, this is what some people use to justify and say, well, we're in a bubble. Because when you get people where the stock market is not necessarily what they do all the time, but they see it as a way, just kind of as a sideline thing, when they start participating, that's when things can get a little bit scary. But we're seeing kind of a pullback in the smart money activity, at least lately. But this is what's been helping the indexes to go up. Okay, earnings growth still looking pretty solid here with tech looking the best. And that's why stocks are going up because earnings are going up. All right, so looking at the intraday chart, just higher open, and we were able to set some kind of a base right after the open at the daily pivot. And then we saw some buying coming in, took us all the way up above R1. And then you notice how this was a pivot point for Tuesday, but it was also where we set the intraday high. And that's where we topped out in Wednesday session. And we could not get above it. We tried a few times. We came back down to R1, and that was providing pretty good intraday support. But then we did bounce up and close just a little bit off of the high. And not much of a change in the initial overnight session. We were virtually flat there, but that could change as I'm recording this. This is still before Europe opens for their session. And we are seeing, again, in the bigger picture, this is still looking okay. The blue line's now starting to go above the red line, very short term. But if you go back to the beginning of August, we're seeing the general intraday movement of both the red and the blue chart continuing to go up. Did I say green or did I say blue? This is improving, but not showing a lot of conviction right now. Growth to value intraday for the S&P. We want this to continue to go up to be more positive. So growth was up more than value for the large caps and up double. Well, not quite, but just about double for the mid caps and up a little bit more with the small caps. So looking at some other indexes here, we saw a big improvement with small cap growth to value. We just generated a death cross here with this ratio, and then we've been seeing a bounce back up. If that can continue, that would be more positive for the small caps. We're breaking out again. We have been looking good all along with mid cap growth to value. We spent a little bit of time below the 50-day moving average of the ratio, but then we're looking pretty solid here. The index isn't doing all that much, but under the surface, there's a lot more growth than value being bought right now. We're improving, but still below the 50-day moving average with S&P growth to value. We want to get back above the moving average, show more conviction, and continue to go up to be more positive. And still at the high end of the rainbow with this growth to value ratio. And not doing as good lately, but in the bigger picture, still looking good with discretionary to staples. Large cap growth setting a new all-time high. And here's the short-term trend where we're coming down still. We had an up day and we're going down with the green line, but we also saw the red line going down. But the ADX is still above the moving average. That signals a strengthening positive trend in the short term. Same thing here, above the moving average, green line coming down, but it's still a strengthening intermediate term positive trend. And we are below average with volume. Last couple of trading days, we had a bit of a down day on Tuesday, a bit of an up day on Wednesday, but this is all happening on below average volume. And then sentiment here, we're now starting to eye in the 6,800 level as far as gamma exposure. We're seeing this blue line really going up and crossing above this other wavy blue line here. That is likely to be not only is it a round number, but it's also another point of potential overhead resistance where we closed at 67.54 to round that up. We do have some support down here at 67.40 if we drop a little bit down there. And then the next area down, according to gamma exposure, would be back down to 6,700, which we were just testing on Tuesday. And so now we're bouncing up from that. Okay, still not seeing a lot of fear in the VIX, either with the line chart or bar chart. Still not seeing any negative seasonality, meaning the VIX is going up as stocks are going down. And still hanging out around the moving averages with the VIX of the VIX. This is still where we're seeing some concern. The VIX to S, and I don't know why the words here are all different. I loaded up all my stocks and it's like they automatically went in and changed all the fonts to different sizes. So it's kind of messed up some of my annotations on here. But we are coming down a little bit with the S&P to VIX correlation, but we're still getting a very high reading. As I try to point out, other times when we spiked and finally started to come back down, and you match that up with what happened based on price, not all the time, but a lot of the time it meant at least some kind of a short-term pullback. But we've been watching this chart for over a week now, and we're just not really seeing that. And we're still declining here with the 253 period equity put call ratio. This is long term. I wanted to show this. I haven't shown this in a while. I usually only show this in the deep dive video over the weekend, but this is declining. That's still looking positive there. We are turning back up a little bit. This is a little bit of a concern with the VIX, the 3-month average of the VIX, and then doing a ratio. We had been declining as the S&P was going up. We're seeing a little bit of fear coming back in. Now, this could all go away and we could resume with this going down, and that would be positive, but we just want to be aware of it for right now. Also been showing this, the volatility of stocks to the volatility of bonds ratio. We're still going up with the moving average, whereas we were going up with the S&P, this moving average was actually going down. And we're seeing a shift in that that's now continuing to play out. And then we're also turning up here a little bit with the VIX to VVIX ratio, where we had been declining with this particular measure, now it's also starting to turn back up slightly. So not these are signs of fear that are getting picked up that we're not seeing in the VIX in and of itself. And we went up with this fear gauge and we were down just a little bit with this other fear gauge. So not a confirmation there. Now we are looking good again here with the risk on to risk off ratio after chopping around for a few sessions. We are breaking out and setting a new high here. That's positive. We're also breaking out with the high beta to low beta ratio, which is positive. And we're going down here with the value to tech ratio. That is positive for the market. And here's the daily equity put call chart. We were pretty much flat here. So we're ticking back up, but still extreme negative with the 5-day chart. This is another look longer term. This is where we watch this a little more closely when we drop below this green line, because a lot of times when this goes down, that could mean some kind of a topping um, environment for the S&P, but we're not quite sure when that's going to happen. And we're also kind of pretty much sideways here. We went down just a little bit with this 10-day moving average of the equity put call ratio after getting to a very low reading here. But we're still getting a high reading with volatility risk premium. So as I've been pointing out, we're seeing risk in this chart. We're seeing risk in the S&P to correlation, the VIX correlation chart, and a few of the other measurements that we look at, but we're not really seeing it in the VIX in and of itself. Advanced decline line ticking back up here, but not setting a new all-time high, where we are setting a new all-time high based on volume. And that is more positive. We've been seeing volume leading price. So we're still above zero, a little choppy here with the advanced decline ratio, both short and intermediate term, but this is still positive. And not showing a lot of conviction here with the advanced decline oscillator. Still above zero, hitting new all-time highs. We would like to see a lot more strength in this particular indicator that's just not there right now. And we are dropping off. Now we're setting all-time highs with the S&P, but we're drifting down here with the new highs minus the new lows. But that's still keeping our 5-day chart and our 10-day chart going up. And we are now back to looking more positive with the accumulation distribution. We never turned negative here with the top chart. We dropped below the moving average with the boom indicator, and now we're starting to go back above it. But you can see here just a lot of flatlining here with the MACD. We're not really seeing any big movements along the way lately. And we're starting to turn back up with the chicken money flow. We were negative after Tuesday, actually after last Monday as well. But we saw enough of a bounce in the histogram to slightly turn the red line back up. We're also turning back up with the chicken oscillator, but we're not above the moving average yet. So it's improving, but still negative. And we declined a little bit with the vortex, went up a little bit with the red line, but in the bigger picture, the vortex is still positive. We're still above the moving average with the advanced decline line studies for the S&P, still below the moving average with the NYC common stock, improving, but below the moving average with the mid caps and small caps. We're still above 50 with those stocks in the S&P above their 20-period moving averages. But again, setting highs here, and this is just kind of floundering around a little bit positive with these negative divergences still showing up longer term. And not much of a change with the 50-period moving average study, a little bit of a tick up with the 100. And we actually declined a little bit with the 200-period moving average study. So we are setting a new all-time high here. Still looking pretty good with the chart pattern. Higher highs, higher lows. And of course, you can't get much more positive than a new all-time high. But you can see we've been going, at least Monday and Wednesday, we were looking pretty good here. But we're dropping off with this based on volume. And still a little bit above 50 with the 20, 50, and 200 period moving averages. But not big changes overall. And we are above the midpoint with the Stochastic RSI, but we're not up into this extreme area yet, which is showing more positive conviction here. But we are back up. We dropped down below after Tuesday. We're back up into this positive conviction area with the Williams percent R, CCI 14, and the CCI 20 also still showing good short-term momentum. And we're pegged out at the top here right now with the short-term stochastic. We're turning back up and extreme with the intermediate short term, and we're still extreme but positive with the long short term stochastic. Force index just hanging out right around the midpoint, not showing off a lot of conviction there. But the short term trend based on 20 periods, that's still positive. We haven't quite gone into the +3 channel with the standard deviations chart, but this is still positive overall here. We did see a bit of a bounce, really choppy lately with the balance of power, but it's still positive. Positive with the go, no go. Positive with the highest high value chart. On day 111 with the Landry light. On day 105 with the proper order. Still seeing a negative divergence here with the TTM squeeze. Going up with the S&P, the TTM squeeze is going down and is negative. But we're not seeing that an awful lot in other indicators. And for months now, going back to June, we've just been hovering a little bit above zero here with the ease of movement. The Arun is still giving us a pretty high reading. That's extreme, but when it's giving us this high reading, that means the buyers are in control. The sellers are kind of not really controlling things currently. We're still just barely above zero with the S&P McClellan oscillator, not what you would normally see after setting an all-time high. We're still going up based on price and volume for the summation index for the S&P. Still below zero with the NYSE McClellan oscillator, so we're declining based on price. Holding up a bit better. You can see how we're going down with price. We're just kind of chopping along here based on volume. So even though it's declining, it's holding up better, which could be positive. And we're still declining with the Swanland trading oscillator based on price and volume. Momentum still on top of the moving average of the PMO, above the moving average based on price. Still looking more solid here based on volume, even though this is rolling over a little bit based on volume. So we're just right at 50 with the PMOs that are rising. We're right at 50 with the buy signals, and it declined a little bit. Declining a little bit, but coming in at 62 here with the percent of PMOs that are above zero. Going from neutral to positive with the Elder's Impulse system, parabolic SAR is positive, and drifting down with the slope oscillator, and drifting sideways with the MACD, still seeing a negative divergence here. Going down with the slope oscillator, going up with the TSI, those are the two short-term oscillators, flatlining with the three intermediate term, and also flatlining now with the two long-term oscillators, and still negative with the Copic curve. And not quite extreme here with the Sean trend meter, but it turned back up after declining. Positive with the money flow, ultimate oscillator, on balance volume. And we're just below 70 with the intermediate term RSI. We're crossing above 70 with the short term RSI. Short term trend here and going into intermediate term trend, still looking really solid here with the bow tie method. Intermediate term trend, red line, blue line, going up, positive there, above all the plotted moving averages. Getting kind of far away from the 50 period moving average. We're not quite there yet with the 20 period moving average. And we're still more than 10% above the 200-day simple moving average. We're at 11.78%. If we do continue to go up and we get up to 12, 13, 14, maybe 15%, that's going to cause some more concern. But we watch it when it's above 10%, but we get more concerned the more this goes up, if that is what ends up happening. And not seeing a lot of conviction here. We're actually still negative with the bullish percent index for the S&P. It declined again. And still coming down a little bit here with the NASDAQ 100 bullish percent index. Ticked up just a little bit with the NASDAQ 100 bullish percent index. Still coming off of a praying bottom Fisher buy signal. Okay, and then still looking pretty good here with the weekly chart setting a new all-time high. We're now up 0.56% on the week, but we still have Thursday and Friday to go. And now we're back to looking more positive with our different ways of looking at the trend with the Heiken Ashi. The Kagi chart is positive, Renko chart positive, three-line break chart is positive. Long term, we actually came down a little bit here with the 150 moving average steady and the 200. But these are still looking pretty solid overall. Positive on all time frames. We switched back to short-term positive with the mid caps. They had gone negative after Tuesday. Now everything is back to positive. And we are still in an uptrend with the dollar in the short term. So we saw that, especially tech, it really led things here. And that's what drove the indexes up. And then industrials, utilities, again, that you could say that's a growth area. But then energy ended up being down the most, but still not much of a decline there overall. Communication ended up being down slightly. So we have some positive, a few negatives along the way. With the materials sector, we had an ETF bullish MACD crossover. That's positive. Same thing with the BPI cross above 70 with healthcare. Discretionary had a BPI cross below 50. Been seeing some weakness coming in there lately as Tesla, it was up, but it's been under pressure lately. And then we have the NASDAQ going above 22.8, 22.9, setting a new all-time high with the NASDAQ as well as the S&P. Earlier on, we had the real estate having a BPI cross below 50. So an awful lot of green up here in the big growth areas. When we look at tech, saw the Google stocks were down. Meta was up. That's why communication was under a little bit of pressure. A lot of red here with the financials, especially with the big ones. And discretionary, we had Amazon and Tesla also being up, but an awful lot of red in there as well. So the Dow's actually been drifting down. We were unchanged, but we're not really breaking out with the Dow here. After we came up to this R1 pivot point, that's about as high as we've been able to get over the last four trading sessions. If we could break above that, that's going to be more positive with the Dow. We're still neutral with the Elder's Impulse system, setting a new high with the NASDAQ. Positive after being neutral with the NASDAQ here, setting a new high with the NASDAQ 100, also going from neutral to positive with the Elder's Impulse system, and still just kind of drifting with its moving average when we look at the momentum for the NASDAQ 100. And we were up okay here with the S&P 600 small caps back above this pivot point, up a little bit over 1% with the Russell 2000 small caps, still looking okay here as far as the chart pattern. And we've gone from neutral back over to positive with the small caps, but we're just kind of drifting along sideways still with the mid caps. Now, we had dropped down below the pivot point. We were able to get back above that. And we've gone from negative to positive with the mid caps with the Elder's Impulse system. The Wilshire just looks like it's setting a new all-time high there. If not, it's really close. Also really close to a new all-time high with the total US stock ETF. Then here we look at the financial sector, still above the 50-day moving average. It was down almost 0.5%, underperforming when we do a ratio with the financial sector to the S&P, and we've been seeing that going back to last spring. So then what I did is I found a different chart. This is ARC FinTech, which is another way of looking at the financial sector. This is doing pretty good and setting all-time highs here. And then we do a ratio with the SPY, not at all-time highs, but holding up a bit better. FANG index, not at an all-time high, but it was up 1.61%. So Apple was up on the day here. We had Amazon up over 1.5%, coming back up to its 50-day moving average. Microsoft, not really much of a change. Still looking pretty good here. Google was down almost 0.5%. Meta was up 0.2%, still below its 50-day moving average. Nvidia up over 2% here. That's where a lot of the strength came from. And then Tesla was up 1.29%. And that helped the discretionary sector, but not as much as we would like it to here. We did see a nice little move up back to the 50-day moving average with Netflix. And then here's the semiconductor, setting a new all-time high here. That's positive. The SMH semiconductor setting a new all-time high, and we're well above the rainbow with the SMH ETF. Looking pretty good here with the semi to tech ratio. This going up, that means the semis are outperforming the tech sector. Still going down with this ratio, that means staples, which are more defensive, toilet paper and toothpaste, they're underperforming the tech sector. And the staples are also underperforming the S&P itself, and that's more positive for the market. And then we see a pretty strong short-term correlation between U.S. and world stocks, and it's still building slowly here with the longer-term correlation. Oil did go up. We're getting into the 62 range now, and we are still going up here with the U.S. dollar index in the short term. And we were unchanged with the 10-year yield, virtually unchanged with the 10-year based on price. So we are improving with the Qs to S&P, and that's where the strength is coming from right now. We're above an advancing moving average. This had been doing better when we look at discretionary to the S&P, but now we're falling down further, even below the moving average, and the moving average is rolling over. We are still above an advancing moving average when we compare large cap growth to large cap value. So we're back above the moving average with the large caps. Mid caps looking pretty good there. A really nice improvement here with the small cap growth to value ratio. So our outlook, I haven't changed this. It's like we have an up day and it's like, all right, here we go. Then we have a bit of a down day, but it hasn't really changed anything. Then we have another up day. We set a new all-time high, but now we're looking more over towards being more positive right now, and we are above support. If we do go down, we'll still be watching that 6,700 level. We're also watching the 20 period moving averages. Now, we're supposed to get jobless claims and continuing claims. We're probably not going to get that. And wholesale inventories, we'll have to see if that one comes out, but that's not a market mover anyway. We'll see what ends up developing, if anything, with what's going on in the Middle East and then anything else. And there's all these crazy things going on in the US as well. So we're supposed to get some reports on Thursday. We're supposed to get some on Friday. Now that's University of Michigan with consumer sentiment. I didn't hear where they're shut down, so we'll have to see how that goes. But we may not get the Treasury budget. So this is what we're supposed to get, and Chair Powell will be speaking. So we'll see if the market can read into anything hidden meaning wise as far as what he's saying. Now, seasonality, we are positive. If you go back to 2002 in October, the Dow, S&P, and NASDAQ are positive. We're still dealing with a little bit of seasonal weakness here during post-election years with the green dashed line, which is the S&P, but we then see some more positive seasonality after this. And this also shows seasonality looking pretty good going into the end of the year. We're still in the first half of October, which is a good performing half of the month. And we're seeing more of a lockdown. We're starting, or blackout, I should say, not lockdowns. My gosh, did I go through 2020 or what? But this is a blackout period. They're starting to top out. And so this could be actually putting a little bit of pressure on the market. Companies can't come in and buy their own stock when they're on blackout because they're getting ready to report their earnings. And then this is still going to be pretty strong going into next week before it starts to taper off. So now I still have the three smart money indicators on the negative side. I could have just as easily put them over on the positive side. Accumulation distribution looking more positive. We are positive with the Chaikin money flow, but we're still negative, although improving with the Chaikin oscillator. We're still below zero with the McClellan oscillator for the NYSE, which is causing the summation index to go down still based on price, holding up better based on volume. Still drifting down, not really showing a lot of conviction with our momentum oscillators. And we're still not really seeing a lot of strength with the bullish percent index for the S&P. Swollen trading oscillators continuing to decline as well. But then our growth to value ratios showing some improvement, more improvement than what we've seen in a while here. And we're still positive with the McClellan oscillator and summation index for the S&P. Bullish percent indexes for the NASDAQ 100 and NYSE are still above 50. And then we have our secondary indicators, ease of movement, money flow, ultimate oscillator. They are positive. Vortex is positive. Praying bottom fisher buy signals hanging out there. And the momentum, it hasn't officially gone over negative with the NASDAQ 100, so I'm keeping it on the positive side now. And now the financial sector by itself, when you compare it to the S&P, holding up much better if you look at the FinTech, the ARK-F ETF there. That is doing better. And then our long-term special K oscillator continues to be positive. Here are the pivot points for Thursday's session. So our conclusion, haven't changed this. My goodness, we're still positive. We're above support for right now. We're seeing more positive conviction starting to develop. If we drop, we'll be watching the 6,700 level as well as the 20 period moving averages. But we're still, I mean, that would be a pretty significant drop from where we're at right now. And we're seeing some improvements, some weakening intermediate term, bullish percent index going down. And but then we see some strengthening as well, like we're seeing some improvements with the summation indexes for the S&P. And we're still more than 10% above the 200-day simple moving average. We're just keeping an eye on that. So thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.